Hi, everybody. This is Gary Dean with Sentiment Timing, and this is our technical video report for Sunday, January 7th, 2024. Friday, we had the non farm payrolls that came out. Much better than expected, but I mean, I've been writing uh, so many times that these front numbers they're made up numbers. They really are, and they're really there to try to jolt the market or do whatever they want. But if you go back and you look, the last I think 8 months, the months prior are all being lowered. They're being their original forecast or report is being revised down, and people forget about that part of it, and they just take the headline number and that's it. But when you come down to everything, I mean, even in that report, I think most of the jobs were it came from government workers and stuff like that, and that's just not healthy. But in any case, we did see a spike in. Well, it's the first thing we saw was the market was down. Then it rebounded back up by the time the market opened, and then the S&P was up 25. And as soon as it ran into the moving average, sellers stepped in. We brought it down, and we ended up finishing the day +8. Nothing, nothing crazy, especially after the first few days that we've seen of 2024, where the markets have been down. And as I said, the Nasdaq has not been down 3 days in a row. I think going all the way. I don't have the number in front of me anymore, but I mentioned it the other day. It's a pretty long time. So I think a lot of people are really second guessing this euphoria trade that went out, once the Fed pivoted. And interest rates are starting to go up now. Oil is starting to go up now. And, Bernanke's going to end up being wrong yet again. And it's just really proven that the Fed, they're just trying to figure out what to do here. They messed up for going on, from 2009 into 2022 where they left the rates artificially low, and that was the biggest mistake they've made, and they don't know how to get out of it. And a lot of people that are turning around and saying, using comparisons, from history, they're not really using the correct formula because like I said, everybody's anticipating that the Fed's going to start lowering rates, but they don't. Nobody really has a clue. And from everything that I'm gathering, inflation's going to stay high, and interest rates are going to stay high as well. So this euphoria trade on, the next QE trade, it's for nothing. It's not happening. I don't think it's going to happen again. They tried this experiment. It brought juiced up the stock market, the economy was going, but the thing is it's artificial, and once that breaks, this is what happens. So as of right now, the short term, the Bears are in control. It's the long term, well, intermediate term. Obviously, the Bulls are, just from that massive move that we've seen off these lows. So the Bulls are still in control, but short term, you can see that the Bears are in control. So the head and shoulders pattern, still possibility that it's going to play out. Maybe we find buyers come in at the 200-day moving average on the hourly chart. We're starting to see some bullish divergences. So I wouldn't, I wouldn't discount that. I think that we will see some type of rally that's more than 8 points at some point. And I really, the seeing a move back up to the 47.17, or even coming up to this level here at the 47.30 to form that right shoulder would make perfect sense. And again, now what happens is this neckline starts going down. So it makes if the pattern's going to play out, it makes it more points to the downside, because the way it works is that if it forms this right shoulder here, I should move it over. If it forms this right shoulder, and the target is going to be once it breaks the neckline. So if it's moving down and it breaks the neckline at 46.50, and we're talking it's 130 point move. That's what the target's looking for. It's going to bring us down into our target area. So I think this right now is healthy for the market. If the bulls want to try to have a sustained move, because the move that we saw from the October lows, as I said, it's not sustainable. So the Bears, they need to get it through this pivot right here, 46, 62. If they do, we should see a quick move down to the 4,600 level and more likely down to the 45.40. So if they come down to this support, I do believe there'll be buyers. But as I said, I think a healthier move would come down to the 44.24, which would close this gap, give the, put some doubt into the market, and then it would allow for the Bulls to, to start another rally into the springtime. The Bulls, they're going to really, their thing is they're going to have to get it above this 47.21, 47.28. This is the heavy resistance. If they do, then we anticipate that they're going to come up and close this gap at 47.61. So let's just see what plays out tomorrow. Enjoy the rest of your Sunday, and I'll talk to you guys in the morning.